Hello, everybody, and welcome back. Today, my guest is Praveen Jagwani. Praveen is the CEO of UTI International offshore arm of one of India's largest money managers. And today, we want to discuss recent developments and attractiveness of Indian equity market. Welcome, Praveen.
Thank you, Thomas. Good to be here.
Praveen, the Indian stock market has outperformed other Asian markets over the year, despite the challenging environment. So what do you think are the main causes for this?
According to the IMF, World Bank, McKinsey, it is now widely acknowledged that India is the fastest growing global economy, not just for 2022-23, but also for the remainder of this decade. So that's the broad context within which I guess one should view the performance of Indian equity markets. I would say there are two main factors. One, there's a bigger share of domestic investments in Indian equity markets since ever before. To give you a sense, domestic institutions plus domestic retail today account for 22% of India's market cap, while foreigners account for only 18%. This is significantly different since the position, let's say, even 5 or 6 years ago, where foreign holdings of Indian stocks made a big difference to the direction of Indian equity markets. So as Indian economy has done well, domestic demand, domestic consumption have led to improving earnings and a general sense of excitement within the Indian society, which has created a bigger case for equity investment. So that's reason number one, why Indian equity markets have done well, rising domestic investment in equities. Second reason is the rebalancing of global indices. While India is the fastest growing global economy, today it accounts for 3.3% of global GDP. But only 1.6% of the major sort of global index, the ACWI, for example, All Country World Index. So this difference between being a substantial economy but not being adequately represented in the indices is causing the smart money, the institutional money in the world to come to India. So as they always say, by the time the New York cab driver is recommending India, it's probably too late. But at this point, it's only the smart institutional money that is moving to India. And that's the second big factor which is driving up Indian equity markets as vis-a-vis the performance with the rest of the emerging markets.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So fortunately, commodity prices have normalized somewhat, but how vulnerable is the India business model to eventually further commodity price shocks?
Commodities in general and oil in particular have always been India's Achilles heel. And if I could list out India's main imports, the biggest is oil, followed by gold, followed by diamonds, followed by coal, and then natural gas. So these are top 5. And obviously, as prices of commodities go up, it creates a rising import burden for India, and that feeds through the economy, inflation, so on and so forth. I would say oil is the biggest culprit. And given that our outlook is next year, 2023, the world will slow down dramatically, if not fall into recession. The UK is already in recession, Europe in technical recession, and US most likely to follow suit. Given such a global environment, we don't see commodity prices rising or oil increasing significantly. So there is no short-term risk to commodities from an Indian economy perspective. So we think, given that oil has come down from a high of 120 when the Ukraine invasion started to now under 80, India is in a fairly comfortable position, but always on the edge with rising commodity prices and oil prices. So that will always be something to watch out for. other factor this year has been the extraordinary strength of the US dollar, which also has an impact on current account deficit for India. But on the whole, the outlook for the next few years, given recessionary or low growth conditions globally, is quite positive for India.
We've seen the underperformance of Chinese stocks during this year. So is China's weak attractiveness an argument for Indian equities? And to what extent do you see correlations between these two stock markets, or are they even negative correlations?
Yeah, that's an interesting one. Ever since Jim O'Neill of Goldman Sachs coined the BRICS framework, the world began to think that Brazil, Russia, India, China are very similar to each other. And of course, everyone knows now, in hindsight, that they all are hugely different. And, we launched a fund about 10 years ago, an India-China fund. And almost in none of the years did India and China perform in the same direction. So you're right, the correlation is quite low. And the drivers for China are very different for the drivers from India. China's business model, if you will, is top-down, state-led investment. When China turns on the infrastructure tap, the country does really well, GDP goes through the roof. India, the driver of India's economy is middle-class consumption. So nothing to do with the government or top-down, it is completely bottom-up. So China is top-down, India is bottom-up. I would say that they become very complementary in a portfolio to each other. But given the fact that China is kind of imploding because of COVID lockdowns, because of their policies, which are seen as not favorable to an open, transparent world, and what they've done with subverting democracy in Hong Kong, so on and so forth, there is a gradual shifting of global investment from China to other markets. And notably, of course, there's Vietnam, Indonesia, Mexico, and others. But India is getting a disproportionately large share of investments that are flowing away from China and to India. So India has been a big beneficiary of this global turmoil and geopolitics, if you will.
Lately, we've seen this protest in China against the strict COVID regime. So how likely do you think is an easing of COVID restrictions and lockdowns in China? And what effect would this have on the Indian economy?
Interesting thing about China is no foreign power for the last 3,000 years has ever been able to colonize China. All of China's upheavals have been internal. Revolutions have upstaged dynasties. So this time around, it is no different. And we think at some point, the social ferment will boil over and to bring about change in China. I don't know whether that thing is 6 months from now or 6 years, but there is a growing sense of concern with depleting middle-class wealth. First, it was the real estate sector, the mortgage, which dented middle-class household savings and investments. And now it's, of course, the COVID lockdown, which is never-ending. It is having a very negative impact on society. And of course, the equity markets have followed suit. Chinese equities are one of the cheapest we have seen in a long time. And all of this is creating a sense of discomfort for the global investor. Every time a global investor thinks, a pension fund in Europe or in Australia or in the US, they think, I think now China should come out of it. And then the Chinese do something which adds to the discomfort, which is why companies are moving their supply chains away gradually. You saw that with Samsung, you saw that with Mazda, the car manufacturer, the chip manufacturers. You're seeing it with the electronic component companies, the pharmaceutical companies. Slowly and steadily, they're moving their supply chains away from China to other countries. And like I said earlier, India is a big beneficiary of this. And the longer China remains in this COVID lockdown state, It creates the discomfort of global governments as well as companies, and India will remain a significant beneficiary. And the Indian government is actually taking big advantage of this by attracting foreign investment. They have set up a specified unit in the government to fast track foreign investment into India, particularly the ones that are coming to relocate from China.
So we're currently living in this environment of rising inflation, rising interest rates, a strong US dollar, and weak growth expectations on an international scale. So which Indian companies and industries are coping well in this current scenario?
I would say that to some extent, global problems are not fully reflected in India. For example, for the first time in history, India's inflation is less than the inflation of UK, US, and Europe. As a result, Indian interest rates have not risen as much as elsewhere. And that would tell you that Indian central bank is still focused on growth as against inflation. And coming out of COVID, India staged a very significant recovery, one of the fastest demand recoveries we have seen. And services sector did much better. So people who were deprived for a few months have gone back to flying, traveling, restaurants, all of that. So services have done much better. Of course, manufacturing suffers on account of rising interest rates. So margins decline, rising commodity prices, so on and so forth. So services in general have done much better. But I would, as a house, we have always believed that the best way to invest in India is to invest in high quality growth businesses. By high quality, I mean businesses that have consistent and predictable generation of cash flow. So the business models are so strong that no matter what is happening in the external environment, these businesses, whether it's manufacturing pharmaceuticals or banking services or even consumer goods, these companies continue to generate consistent cash flow and grow their market share. These are the kind of businesses that typically do not have any debt. So in a rising interest rate environment, these companies tend to be least affected, impacted by adverse market conditions. And we like these kind of quality growth businesses, which always outperform the equity indices over a business cycle.
So the price earning ratio in the Nifty 50 index stocks has almost halved since its high in early 2021 to around currently 22, close to the 5-year low. So what does it tell us about Indian equity market, and are Indian stocks currently cheap?
You're absolutely right, Thomas. Indian equity PEs have come off their all-time highs. I think back in early 21, you're right, there were PE ratio was about 42, and we are down to 21, 22 levels. But still, I think it would be outrageous to say that Indian equities are cheap at the moment. By historical standards, long-term trend line, the PE ratio of 22 is within one standard deviation of mean. And 42 was about 4 standard deviations away. So not cheap, but we would say that Indian equities are fairly priced at this moment. What's happened over the past few years is that the government reforms that have kicked in, like goods and service tax, insolvency, bankruptcy, financial inclusion, all of these things have given such a momentum to the economy that earnings of Indian corporates have gone up substantially. For the 7 to 8 year period, let's say between the Bernanke taper tantrum of 2013 and the COVID impact of 2020, that period, earnings growth of Indian companies was about 4 to 5%, which is quite poor. Ever since the recovery we have seen post the pandemic, the impact of the reforms having kicked in, we have seen a significant jump in earnings of Indian companies. And we are now looking at the next few years to be about mid to high teens, so 15 to 17% of earnings growth year on year, which totally justify the current PE ratio of about 21, 22. I think from the perspective of global investors, what's happened is that while Indian PE ratios have remained in line, the PE ratios of the rest of emerging markets, notably China, have fallen to such levels that India relatively appears expensive. But I would say that on its own trendline basis, India is reasonably priced and attracting a lot of foreign capital because it is the fastest growing country in the world right now.
When international investors think about the Indian equity market, eventually banks, infrastructure, or IT stocks may come to their mind. Where do you find currently sustainable and affordable growth and buying opportunities for your Indian equity portfolios?
That's an interesting question. And the reason I say that is while global investors are conditioned to thinking about equity markets in sectoral terms, we are committed to fundamental bottom-up research. So we look at each company agnostic to sector, trying to understand what are the drivers of growth for this company. Why do we think that this company will continue to make free cash flow and grow for the next 7, 10, 15 years? So this bottom-up analysis really puts the burden of performance and persistence of returns on the company per se, rather than looking at sectoral insights or thematic insights or macro insights, which has been a much better determinant of portfolio performance and alpha generation as far as our experience goes. So I would argue, again, high quality and growth stocks in India, irrespective of what sector they're in, will continue to lead and deliver predictable returns over the long to medium term. Very broadly, if a stock is in the consumption space, which means there is a correlation between the rising middle class, incomes, rising middle class, discretionary spending of India, then the company would do better than others. Because 60% of India's GDP is really domestic consumption. So export-oriented companies selectively might do well, but domestic consumption, whether it's tea, coffee, soap, shampoo, bicycle, refrigerators, any domestic consumption arena provides a very fertile ground for picking the right businesses.
So this was Praveen Jagwani, CEO of UTI International from India. Thank you very much, Praveen, for being with us today and sharing your insights into the Indian stock market.
Thank you very much for having me, Thomas. It's always great talking to you.